The entire housing market is on the brink of failing. Although that may seem like a bold statement, it is supported by unquestionable evidence. Almost all housing indicators are giving forth ominous indications. Record low mortgage applications, soaring evictions, poor consumer confidence, bankruptcy, as well as a housing bubble are the issues we're discussing. Welcome to our channel, Financial Experts. The property market will completely collapse over the next 12 months, shocking the whole world. The U.S. home market is already experiencing a downturn, claims the National Association of Home Builders. Property development has exploded in a bubble-like manner as a result of the dramatic increase in property prices over the previous 10 years. There are more newly constructed privately owned homes compared to ever before. There are currently more than 1.6 million dwellings under construction, which is 12.5% more than during the housing bubble of 2008. There won't be any purchasers when hundreds of thousands of homes are put up for sale in the coming months. Monthly declines in housing sales are currently occurring. 500 million units per year is a 5-year low for new single-family home sales. Consumer confidence polls reveal that Americans no longer hold high house values in high regard. For 8 months in a row, the Wells Fargo index has decreased, reaching just 49 out of 100. This alarming trend indicates that housing confidence will soon reach levels reminiscent of the 2008 crisis. To see my ultimate verdict, watch the video through to the very end. There are other indicators as well as the Wells Fargo index that reveal a troubling pattern. Consumers' confidence is at an all-time low, according to surveys conducted throughout the country. The National Housing Market Survey from Fannie Mae is the finest example of awful customer opinion. 79% of Americans believe that now is not a good time to buy a home, according to the study. On the other hand, only 17% of people in the population think now is a good time to purchase a home. Since the survey's inception in 2012, the disparity between the two percentages is the worst Fannie Mae has ever observed. Prices will unavoidably decrease when everyone believes that the property market is about to collapse. The Mortgage Bankers Association reports that the demand for mortgages has reached its lowest point in 22 years. Rising mortgage rates are one of the main factors contributing to poor consumer confidence. Mortgage applications are falling like flies as a result of interest rates reaching all-time highs. Jerome Powell, the head of the Federal Reserve, yesterday maintained his unwavering commitment to rising interest rates. Capitalization rates will topple the pillars of the housing market. Institutions flock to the housing market throughout the last 10 years to develop investment products. Commercial purchasers accounted for 13% of home sales in 2021, up from only 11.8% in 2020, according to the National Organization of Realtors. With the acquisition of new housing units costing billions of dollars, companies like Blackstone have increased their presence in the real estate industry. Capitalization rates, or cap rates in short, are the main reason why organizations gravitate towards housing. The rental sector is under tremendous strain since Powell is set about raising rates to 4% by 2023. The CBRE Group estimates that the average cap rate for multifamily properties was 4.6% in the fourth quarter of 2021. Investors in real estate will experience a large decline in their margin of profit if interest rates rise in the future. Every month, the spread between the 10-year Treasury yield as well as the multifamily cap rate widens. The spread, commonly referred to as the difference, denotes the additional profit made by real estate investors from their holdings. There is no incentive for investors to make investments in multifamily cap rates if 10-year Treasury rates are greater than the multifamily cap rates. Purchasing a 10-year Treasury rate is very easy as clicking on a button on your phone. On the other side, buying multifamily properties requires a lot of effort. Investors would just sell their buildings to buy bonds if pressing a button generated more money than employing hundreds of people to manage multifamily complexes. The 10-year Treasury yield is currently at 3% and is expected to rise to 4, 5, or possibly 6% in the near future. Investments in real estate will suffer as a result, and they can even start losing money on their investments. Numerous real estate speculators started obtaining adjustable rate mortgages as a result of the steep rise in real estate values. The interest rate on adjustable rate mortgages, or ARMs for short, varies with the market interest rate. Due to the high cost of real estate, ARM usage has significantly expanded during the past 10 years. When borrowing rates are low, ARMs perform remarkably well. By 2023, interest rates will abruptly soar to 4%. Some investors may begin to experience a loss, particularly those who have investments in locations with low cap rates. Many investors will be forced to list their houses for sale. This is due to the fact that some individuals won't be able to pay the extra interest if ARM rates climb in the upcoming months. Evictions. Eviction filings are soaring right now due to two key problems. Landlords are evicting tenants en masse at the moment, and areas like Connecticut are seeing a sharp rise in eviction filings. The U.S. government's restriction on evictions during the epidemic is the primary cause of this. Landlords were barred from evicting renters during the epidemic by laws like the COVID-19 Tenant Relief Act. Additionally, the U.S. Treasury Department contributed more than $46 billion to help tenants pay their rent. State governments then began their own rental assistance initiatives in addition to all of this. Additionally, several states have temporary bans on evictions. With all of the assistance from the government, evictions were avoided during the pandemic. As a result of the bulk of these programs have expired, the number of eviction requests is rapidly increasing. Due to excessively high rental prices, evictions are increasing for a second reason. The cost of property and inflation forced landlords to drastically raise rental rates. From pre-pandemic levels, rental prices in several cities rose by 30 to 40%. Due to rising costs, some renters are just unable to make their monthly payments. Over 23% is a 10-year high for rent-to-income ratios. The level is quite high and lately prompted many individuals to find themselves homeless. This portends a rise in evictions in the upcoming months. Along with those being evicted, the number of new apartment leases is also drastically decreasing. RealPage reports that the new rate of new apartment leases is rapidly reducing, which means that in addition to existing renters being evicted, the rate of new residents is also slowing. Landlords are also suffering a lot, just like tenants. Banks. Banks are losing a sizable portion of their earnings as a result of the record low mortgage demand and unpaid rent. The bank disclosed a starting 79% decrease in mortgage revenue from the prior quarter. I wouldn't be shocked if Wells Fargo soon began experiencing losses given the steady reduction in mortgage applications. Wells Fargo started firing employees in its mortgage sector as a result of its underwhelming performance, but the bank is only one fish in a sea of other banks. In the most recent quarter, the profits of Wells Fargo, JP Morgan Chase, Bank of America, and Citibank all fell by 20 to 50%. Due to the size of their combined market shares, the four banks are often referred to as the Big Four. The total amount of assets held by the four banks is close to $9 trillion, or around 45% of the US GDP. Many mortgage lenders began issuing non-qualified mortgages, or non-QM in short, during the 2021 real estate boom. Non-QMs, in contrast to conventional programs, employ different techniques to determine whether borrowers are reliable. While predictions for the housing market differ from person to person, the majority of banks are aware of an impending problem. According to Goldman Sachs predictions, home activity would drop by almost double digits in 2022 and 2023. In 2023, I would say that the fall in the housing market would be closer to 15% to 20%. The wealth impact means that the housing crisis has wide-ranging effects. According to the wealth effect, a rise in your personal net worth will have a positive impact on your consumption. You'll probably cut back on your spending if your net worth suddenly drops. According to studies, the wealth impact is more pronounced in the housing sector than it is in other assets like equities. Guys, unfortunately, we have reached the end of this video. Let's meet again. Thanks for being to the end of the video. Don't forget to like, share, subscribe, and tell us what you think about this video below in the comment section.